live. Excellent connection.
Okay.
Yeah.
Trevor. We're
Hey,
finally
Josh.
here.
We're finally here. It's only been, 2 years in the making, or has it been longer?
Yeah, that sounds about right. Year and a half or so, I think, since we got into this space with this idea of doing our podcast, right? So
Yeah, and we've been trying to get this done because we didn't know what content we wanted to talk about, what was
Yes.
going to be discussed. So it was a little bit challenging. Oh, I keep forgetting to cut to me. So there we go. We're brand new at this, guys. So this is podcast number 1 of many. So hopefully we can, do a lot more of this. But I think really what spurred this on was 2 things. Number 1, you had a bet with a bootcamp attendee
yes.
who said, hey, you didn't do any content from the time of the last bootcamp to this one, so you owe me $100. And, like the honorable guy, you went ahead and you paid the $100. But I was like, Josh, this cannot happen.
I paid the $100.
Yep.
Yeah. He got $100 off of me. He's not getting $100 off of me this time, though.
That's right.
Yeah.
And then the other thing was this past boot camp, I think it really resonated with the attendees, just because of how the type of content that you put in there, all about building wealth, how to do it as with a regular wage, as a middle class, business owner in Canada, and really getting them to that $1.2 million net worth, and really paving that pathway of how to get there. I think that resonated with people, which is why we're doing this podcast, and we can really help people, achieve those goals, even in the political climate and the tax regime that we're under right now.
That's right. That's kind of what we're going to do on this podcast is, how to beat the odds of building wealth in Canada. And, the
Get a little bit closer.
The objective, it's like, it's really clear, right? So we'll take it to the screen and we'll show them the infographic. It's like the infographic to end all infographics, right? It's essentially like, what does it mean to build wealth in Canada? People talk about it, but like, what does that actually mean, right? And so you have the top 73% of Canadians, the top 20% of Canadians, that they actually own 73% of all the assets in Canada. It's wild. It's kind of the old 80-20 rule. It's not quite 80-20, it's 73-20, but like it's pretty close. And what does that actually mean? It's like they have a net worth of $1.2 million or higher.
Right.
And so it just became very clear throughout my career. It's like, what am I actually trying to do? Every meeting with a client, every year over year, it's like they're running businesses, they're making financial decisions. It's like, what are we actually trying to accomplish here? It's like we're trying to get into that top 20%. That's like the first goal, right?
Yeah.
And I think I said at the boot camp is like, I got to get you there. Somehow, some way, I have to get you to $1.2 million because some people would say there's a work-life balance before that. But in my mind, you're not really going to have any balance or choices before then. If you're just really happy being broke, okay, you don't need to get to $1.2 million. But like, if you're going to be, if feeling broke is going to prevent you from being happy, it's like, I better get you to 1.2 million, right? From there, you can think about like, how do you optimize your life? What is the balance that you want? Do you want the balance? Do you want to go to 7.3 million, go to the top 1%?
Right.
Or we're going to stay, top 20%, right? But before then, it's like most people are on, the inflationary train tracks.
Right.
The train is coming, and unless they get a big enough, grouping of assets, like they're just not getting there because the monetary system is basically designed to move the money from the people who do the work to the people who own the assets.
Right.
$10 million net worth and inflation is 10%. It's like your net worth went up by $1 million. The gas in your car and the groceries that you buy didn't go up by $1 million. Like you only need so much consumables. So at some point it shifts, right?
Right.
$1.2 million, it's pretty clear, right? And so the bottom 60% of Canadians, it's like, they only have 27% of the stuff. And those cutoffs are very much, let's call it the bottom 40%. Or the bottom 40%, they're 200,000, right? The bottom 40%, they have a net worth of $200,000 or less, right? The middle 40%, 200,000 to 1.2 million, right? The days of being a millionaire and thinking that was the end of the game, it's like you're not even at the base level, I don't think.
Not
right?
anymore. No.
It's kind of 1.2 million will be the base level,
Yeah.
where you can have, I'll call it a comfortable lifestyle. Like you could have a comfortable lifestyle. It might not be where you want and on the exact terms you want at 1.2 million.
Yeah, you're still working. You're still, running your business or having a job, whatever that is. It's you're still in that mode, even at a 1.2 million net worth. Because I mean, if you look at it, that can be your home and possibly a rental property, right? Mm-hmm. Maybe you have some stocks or investments in Bitcoin or gold, but still you need to work or earn that business revenue in order to pay for the everyday.
That's right. And could you, retire off of 1.2 million? You could retire off of 1.2 million, but it's probably not going to be the extravagant, millionaire lifestyle that you thought about, right? It's like the meme on the internet you see. It's like what I thought $1 million house looked like when I was a kid, and what $1 million house actually looks like, right?
Just show a house from Vancouver. It's a little shack. And
it's a little shack.
$4 million, right?
If you got a $1.2 million net worth, it's like you're not going to own a house in downtown Vancouver. Like that's not going to be a comfortable lifestyle. You won't be able to afford to pay the property tax, utilities on it. Like it's all tied up in the house, and you'll still have a mortgage on top of it, right?
Yeah. So what does it mean then? So let's get back to this graphic. So what would that mean if someone gets to that 1.2 million net worth level? What's that lifestyle look like? And where do they go from there? Number one, let's maybe map out a path how they get there, and then where do they go from there?
Well, I mean, I think we should even just back up. Right?
Sure.
Because some people maybe are joining us for the first time.
Right.
A little bit, right?
Yeah.
Some people maybe know us, and some people don't know us. But, my name is Josh Spurrell. For the people who are tuning in, who just randomly came across my this page here, right? I've been basically interested in finance and wealth since I was since a kid, right? Mm-hmm. At one time I convinced my mother when I was 17 years old to set up a trading account for me, and it had to be an in-trust account, and of course I illegally accessed the account and made trades on the account that she was supposed to be doing, but she didn't really know how to use the computer that well, so it was fine. I was doing that, and so I started trading penny stocks at 17 years old, and I thought I was really, really smart, and I was really, really dumb. But I was learning, right? And so it's interesting for me now because I'm an old millennial. I'm basically the oldest millennial you could be before I become in the Gen X category.
Right. Almost Gen X.
Yeah.
Nobody's perfect, Josh.
Yeah, but I was trading penny stocks, and I see the young millennials, the Gen Zs now, and they're trading the meme coins.
Right.
I totally get it. I totally get it because that was me, right? But if I had a little more guidance, I could have got where I am today quicker, right? And building a $1.2 million net worth, it's like, I really built a $1.2 million net worth before I entered the top 1% of earning power. So that's like, I tell people it's like attainable. You can get to $1.2 million in net worth, but you can do that without 1% earning level. You can actually do that on median income.
Right.
You have to be more disciplined.
Mm-hmm.
You have to be very patient.
Yes.
And you have to have a degree of knowledge, right? But you can get into that top 20% of net worth on median income, which just requires discipline, patience, knowledge.
Right.
And that's kind of not what we have. Like most Canadians, they're painted in the wrong direction, right? They're taking advice from, say, a big bank, a big five bank, who in one side of their mouth they're telling you they're going to help you build, you're richer than you think type of thing, and help you build wealth. On the other side, you walk down the hall and they're going to sell you a 7 or 8 year car loan. You know what I mean? So how many Canadians out there have more debt from the same financial institution where they have their investments? And I'm not talking mortgage debt. I'm talking credit cards, lines of credit, car loans, debt on stuff that does not go up in value. And they don't have a portfolio that's actually bigger than their investments. And that's just insane. It's like, how can that person honestly say they're acting as in your best interest if they'll sell you that product, right? You're trying to buy $100,000 truck, but you have less than $10,000 of investments. $20,000 or $30,000 in investments. Like, well, why are they not just like, lambasting you, right? It's like if one of my clients asks that, it's like we're gonna have kind of a really, a little bit of a awkward heart to heart on that. It's like, do we actually need that vehicle, right? Maybe a different story if someone's actually running they're running a construction business, and this is how they generate, $200, $300, $400, $500, $1 million worth of revenue. But someone on a $60,000 to $100,000 a year salary, and they're buying an $80,000 to $100,000 car, and they only have liquid assets of $10,000, $20,000, $30,000. It's like, that's just a stupid decision. They can get to that job on the bus. Never mind a beater car. They could get there on the bus, right? And so, like, how do we actually paint people towards that? So going all the way back, at 17, from there, I started my construction company, ran that for a few years, sold that, went back to school to become a chartered professional accountant. It takes me 7 years, to become at the old days, it was a chartered accountant, CA, right? So you had 4-year undergrad degree, then you had to apprentice or article, as we call it, for 3 years, right? And then, I've been working in public practice accounting now since 2008, 16 years. Started this firm 13 years ago, grown the firm to 25 people across the 3 different offices. So, we're amateur YouTubers here. But so it's funny. The other day, I think someone says, "Oh, you're trying to be a finfluencer." I was like, no. I had a 7-figure business before I ever, had an Instagram account.
Right.
Totally opposite, right?
The point of this podcast is to help people in Canada achieve the same thing or better. Yeah. Just by listening to the information and the knowledge that you have to share with them. Because, I mean, you don't need to do this. This isn't something that you have to do because you're trying to earn more income. That's not the issue. Yeah. The issue is so many people in Canada are in financial straits because they don't have the financial understanding or knowledge or training that would help them to get out of the rat race and get out of the salary wheel. Right?
Yeah. How do I help Canadians beat the odds? Right?
Yeah.
Because, like, at our firm, like, there's a certain minimum level we can take someone on that's economical for us, right? The banks will gladly take you on at any wealth advisory level because they're going to sell you some other crappy product on top of it. They're going to sell you a credit card or a line of credit or a car loan that you can't afford, and they're going to milk you for that, right?
Yeah. The banks aren't your friends.
We charge reasonable flat fees. A lot of times we sit down in an initial meeting and say, you're just not, like, you're not ready. Like, I can't help you. Here's what to do, step A, B, and C. But how do we help people at scale? It's like, how do we actually get people to the point where they're ready, where they could buy from us, right? This would be this podcast, right? Because for, let's call 80% of the people out there, it's like, I don't have anything to sell you. Like the Alex Hormozy line is like, I'm Alex Hormozy and I have $100 million. I have nothing to sell you. It's like, I got something to sell you, but for 80% of them, it's not the right fit, right?
Right.
But the rest of them is like, how do I help them, right? So we did the boot camp, and that's been really successful. We did that for, when did we start? 2018. I think it was 2018 was the very first boot camp.
That's right. Actually, I missed the very, very first one because I had already pre-planned to go to Miami to see Grant Cardone's business boot camp. Yeah. And the tickets were already bought. Everything was done. It was set up. So we went to that. But then everyone after that I've been to. But remember when we met at Nate?
You were at the first boot camp. That's what I'm going to say. That's 2018. Yeah. That was the first boot camp. You were there before we were business partners. You were there as an attendee.
Correct.
Right? And then we did and that was, 12 people in a room with me, trying to figure out how to do a presentation. And, like, we've gotten a little better at it, right? Yeah. And so, we've gone from, like, having 12 people in a room to, selling out our, 100-ticket event, like, no problem, right? And so that's kind of where we progressed to. But, like, how do we build that out further? How do we help them further? Because the boot camp's an interactive event. People got to travel, it's kind of by design too, because we can't make it interactive if we had 200 or 300 people there. It's like 100 people that can answer the questions, but more than that, can't really answer the questions, right? And how do we help the people? It's like, maybe they can't afford that plane ticket yet. How do they get in? What are the first basic steps they have to do, right? And so, you know, that's kind of my journey. And then Trevor, we partnered in 2019, I believe, right? It was our first.
Yeah, we partnered in 2019. So my journey is quite different than yours, but we have some crossover because back I think it was almost 26 years ago now. I was married, newly married guy, and didn't really have a direction for my life. So
he's still married, by the way.
I'm still married. Same
that,
woman,
right?
yes, my first wife.
Yeah.
And so I took a marketing course here, and I got a marketing diploma, and I really fell in love with how it worked, like the psychology of selling, setting up advertising and marketing, and really, presenting a business or a product to the ideal and likely buyers, right? So from there, my wife being a teacher, she couldn't get a job in Edmonton, but she did get one in Calgary. So we went down to Calgary, and we were there for 6 years, and I held various different sales positions. So I sold cars, I sold vacuum cleaners door to door, I sold alarm systems, and then from there I graduated. We knew some people at a church we were attending there, and they hired me to be a sales rep. So I went and traveled to all of the different pharmacies across southern Alberta and selling them lotions, potions, soaps, and so forth for a couple of years. From there, I graduated back into the online world somewhat by selling affiliate memberships to people in the United States who want to sell cheap Canadian drugs to Americans, because we have access to generics that they don't a number of years ahead of time. So they were doing that. It was kind of like in a gray area. So I did that for a while, and then life changed. Had a child, right? So now it's like, oh man, life has changed. I can't stay here and do all this. I want to be close to family. My mom was ill, so we didn't know how much time we'd have left with her, and came back to Edmonton. Didn't have the same affiliations, didn't have the same connections. We did start up or purchase a tanning salon, because I still had that entrepreneurial bent in me. And from there, I also started my apprenticeship as an electrician. And I did that for about 13 years.
Yeah.
And I got as high as I could go in the construction trade with electrical. It was either, I start one on my own because I still had that entrepreneurial drive, and I want to be wealthy. Like, I don't want to just earn a wage and by the end of my days, I've got nothing to really show for it. I mean, of course, family and so forth, that's not included. But, I really want to create wealth for the next generation. So I, for the last few years, during my electrical journey, we had built, doing skyscrapers and so forth. And it was fun. Like, it was good, but that was as far as I was going to go.
Yeah.
Right. So I wanted to get back into doing marketing and sales. So dove into the online world. Oh, snap. Something went wrong displaying this webpage. Well, hopefully.
Hit reload. See what happens.
Okay. Hopefully it's
Are we
still
still
working.
live?
Are we still? I hope so. Excellent connection.
I think we're still live. Yeah.
I think we're still live.
18:35. It's
All right.
36. Okay, cool.
So anyways, continuing on, dove back into the marketing and advertising world, and really figured out how the stuff works. So making websites, SEO, social media, and so forth. So then we started Inspired Method. At that time, 2018, I guess we had started. And then a few months into that journey, because I knew we had businesses before, and we totally didn't do a good job of the managing the finances and the taxes and all that kind of stuff, and had bad accountants who just didn't really do their job and let us know, like, where are we at, what are we doing, like, what taxes are due, are we doing this right? So I knew we needed a good accountant, and then we met you at a B&I group, and we came into the office, had a presentation, and it was really a no-brainer from there, because of all of what you offer. Number one, we've got business plan, financial plan. You open up a corporation for us and holding companies, and basically have all that stuff set up for us. So it was like, okay, that's a no-brainer. And then probably 6 months later, you gave us a call, and then from there we said yes.
Yeah.
Yeah.
Yeah. Trevor, I'm buying a marketing company. Do you want it to be yours? I'm going to the marketing business, right?
Let's do it.
Yeah, because I mean, 43% of my clients, 96% of businesses fail. And the most common reason they're going to fail is because of marketing. And people thought marketing was an art form. It's a science. There's a whole bunch of numbers beyond it. It's like you can get lucky and get lightning in a bottle, catch lightning in a bottle on some sort of copy or something like that. But for the most part, it's just like it's relentless brute force, trial and error, measure, refine, launch. Like it would just do it over and over again, right? And then from there, it's like we knew we wanted to start another business.
Mm-hmm.
We almost went back into the construction world. We
Almost.
almost made a poor life choice.
We did. We almost went into building homes. Yeah.
And we almost did it. And then, but, we found out that it's like, you could just see, it's like the barrier was not the construction. And we had a lot of talented clients who were good builders, and it's good because they care so much about, building. It's like I tell people, it's like why I was, what I was good at in construction was managing the people, managing the budget, and selling the projects. What I was not good at is like caring at all about the construction. Like that was the part that I was bad at construction. It was like if the customer's happy and they're going to pay, I could care less if we were good at it. And that's not a good place to be. It's like you should want to be the best at it, right?
Yeah.
I didn't care about that. But when we look at like how money and wealth is actually built in this country, it's like it surrounds real estate, right? Real estate is some of the biggest opportunities, both in the asset appreciation and in the way the thing's financed. People don't know always is that the asset is the real estate itself, but the other asset is actually the mortgage.
Right.
The mortgage is the financial instrument.
Yeah.
It's a way to short the currency that's continually being devalued. Handling it the right ways is the hard part. And so, we realize that these deals don't normally fall apart because of the construction. It's like, although the construction's hard and they solve a problem, it's like nothing happens until the financing's in place.
That's right.
What's the chicken and the egg? It's like, yeah, there's more people who know how to build than to know how to finance it well, right? And especially if you get into any sort of, specialty area. It's like, because I deal, predominantly most of my clients are business owners. And, for anyone who's trying to get a self-employed mortgage, they know it's harder than a regular T4 employee. And so, we have to help them, right? And so, and same thing, people who just have rental properties, people want a readvanceable mortgage.
Yes.
They start to realize that the options are a little more limited, and it's a little more difficult to finance things.
Yes.
And so that's why we thought we're going to start Entrepreneur Mortgage Solutions.
That's right.
And so, we're going to be bringing this podcast to you, Josh Spurrell from Spurrell Associates, Chartered Professional Accountants, and Trevor Salmons from Entrepreneur Mortgage Solutions, right? But ultimately, the goal is the same. The goal is the same. It's how do we get people to at least $1.2 million? How do we help them beat the odds of building wealth in Canada? And it's a structure of how the whole thing fits together, because I think it's a little bit of it's a little bit of a shortcoming in all of our training.
Okay.
You can be a chartered accountant, and they teach you how to manage balance sheets and analyze business opportunities, investment opportunities. They teach you how to manage cash flow. They teach you how to file taxes. Okay, but it's a little bit siloed. And then you have investment advisors where, I think we know my hate on the investment advisor world, because I think it is strong. It is very, very strong. The hate that you have for investment advisors. It's turned into a world of just hawking funds.
Yeah.
They're just hawking funds at 1% to 2% and acting like registered investments in your RSP or TFSA are the only way. And so, okay, I have a problem with that. But even them, it's like they're teaching them, supposedly, if they were good, which there's not a lot of good ones, in my opinion. And I've seen hundreds from clients, right? They're basically charging a percentage of your wealth forever to underperform the markets in which they track. That usually is what you're buying, right? And
Sign me up.
The proof's in the pudding. I have hundreds of clients, thousands of clients over the years, hundreds of investment advisors, and how many of them manage my money? I've seen the performance of all of them.
Zero.
That probably, says it right there, right? But theoretically, if they were good, okay, they're analyzing investments, right? They're analyzing securities. They're making a financial plan for people. Okay, which accountants also make a financial plan for people. It's true. The regulatory issues revolve around who promotes securities. That's where the regulatory issues revolve around. But and then you have realtors, and they're trying to sell houses, and then you have mortgage brokers, and they're trying to issue loans, right? But you look at those four components, okay? So you look at taxes, investments, houses, mortgages. No one really focuses. None of these disciplines really focus on how all four of these put together, right? They don't. Taxes is the single biggest expense of your life, and I filed the tax return for multiple CFPs and CFAs because they don't know how to do their own tax return. It's the single biggest expense, right? And the conspiracy theorist in me is like, sometimes I love conspiracy theories. Anyone who knows me, I think it's like, is that intentional? Are we not supposed to know how these cross over and how we can actually utilize those four pillars to build wealth? Where it's basically taxes, investments, real estate, leverage, borrowing, debt, right? And if you know how to use those strategically, it's my view that you dramatically increase your odds of building wealth, right? And the proof's kind of in the pudding. It's like a lot of people lucked into the $1.2 million net worth in this country because they made one trade and it was their principal residence.
Right.
It was essentially a margin investment portfolio. Like that's what it was, right? They bought an asset that historically goes up by about 6% in this country. A little better in some areas, a little worse in some other areas. But if you look at the average in the last 25 years, it's a 6-point rate of return, roughly. And, they margined it against the mortgage, that, prime rate of interest at about 4.3%. So they arbitraged the 1.7%.
Right.
And as long as they didn't get margined out of the trade, lost their job or something like that, it's like, that's where most of the wealth in Canada is. It's like most people who have a $1.2 million net worth, it's like most of it's in their principal residence. Like most of it is in their principal residence. And they kind of lucked into it. They kind of lucked into what they did. I don't think they really knew what they were doing. They thought they were buying a house where it's like, this is a lifestyle. It's like, no, it was an asset, and it was coupled with a financial instrument. And at the end of the day, it's like every investment position that we take in this country, it's, I shouldn't say every, 99% of investments in this country are made with debt. And this is where it's going to, hurt some people's feelings because they think that the debt is, they think, okay, I'm contributing to my RSP or TFSA.
Right.
But it's not leverage. It's like, really? It's not leverage? Have you paid off your mortgage yet? Because if you are not 100% debt free, every investment you're making is with leverage. You have to understand it. It might not be a mark to market leverage, but it is with leverage, right? How many people wait to contribute $1 to an RSP or TFSA until they're free and clear of their mortgage, right? It's like very, very, very few, less than 1%.
And I think people don't understand because they listen to Dave Ramsey, and their goal is to have a debt-free house. I want to have no mortgage on my house, zero mortgage. But from what I've learned, being your business partner for the last 6, almost 7 years, is that's not true. That's not really the way that you're going to build wealth. So maybe dig into that a little bit, because people are misconstruing. I'm not going to invest until I don't have any debt.
Yeah.
That seems, now that I know better, before I was like, yeah, we don't want any debt. But maybe talk a little bit about that.
Well, start with the smartest people in the world, okay? And maybe the smart is a subjective way, but just look at the big tech companies, right?
Sure.
The big, huge institutions.
So we're talking Apple, Google,
Facebook, Google, the Bank of America. Like, just pull up their financial statements and tell me who doesn't have debt. Because they've figured out that the game is not to be debt-free. They've figured out that the game is to manage debt, to have healthy debt. And if you can borrow at one rate that's lower than a rate that you can earn a rate of return, if you can borrow at 5 and invest at 10, it's like you should keep doing that. provided you can stress test that whole scenario, right? What happens when there's market corrections? What happens when your income turns down, right? It's like the same people for every person who, bought the house in downtown Vancouver for $500,000 that's now worth $2 million. There's someone else who lost it. There's someone else who got margined out of that trade, right? And they might have RRSPs or TFSAs too, but essentially like they didn't understand that everything was, for 99% of people, it's a leverage play. And they just didn't understand those ratios. And, when I look at it, it's like, they taught us, as accountants, like, what is your debt to equity? What is your current ratio? What's your current assets, over your current liabilities, right? Is this an organization where, my current liabilities, I have enough current assets that I could pay my current liabilities, twice? So all the obligations coming up in a year, I could pay them twice. I have enough current assets. Okay, let's start there as a minimum ratio of something that builds a little bit of comfort. And so when I look at that, it provides the foundation, right? Because we knew what those ratios are when we analyze corporations all the time. And so I just analyze every household as a corporation. Every household's a corporation. It has a certain amount of good debt and a certain amount of bad debt, and it has a liquidity ratio. It's, how much equity do we have in this entire pot? Whether it is investments, whether it is real estate, whether it is your business, what do we actually have in there? How liquid are we? When rates spike from 2% to 7%, is this someone that, is this a household that's going to survive, right? When they get laid off for 2 months, 3 months, 4 months, 5 months, 6 months, is that a household that's going to survive, right? What's the income earning power of that business, the underlying business? What's the income that's not tied to the business? What are the different sources of income? It's like, we have to understand that, right? And so once we understand that, it's like we start to make good decisions. There are no risk-free decisions. That what maybe the only part of it, when I look at our schooling, is the one biggest issue I take with the schooling is the so-called risk-free rate of return.
Yeah. Maybe talk a little bit about the risk-free rate of return.
The risk-free rate of return, which is essentially, according to textbook definition, is normally accepted as a 90-day treasury bill, right? Maybe a government treasury bill, which is basically a very short-term bond, doesn't pay a coupon, just pays out a face value at the end, and say it's 2%. And 2.5%, let's say, okay? And inflation, they tell us that's 2%. And so that's supposedly the risk rate of return. But when you start to understand that the CPI number is jacked with it's basically a political number. Now you start to understand you start to understand that there is no risk-free rate of return. It's just a slower melting ice cube. The 90-day treasury bill is basically a slower melting ice cube. If you hold in cash, if if real inflation is 5%. If real inflation is 5%, and you hold in cash, you're losing 5% every year. If you hold at 2.5% rate of return, you're losing 2.5% every year. Okay, it's just the ice cube is melting slower, and that was maybe my growth trajectory of an investor. Is starting to understand that, right? And it's like, if you could go way back when, I thought I was going to be this great speculator and pick wild returning penny stocks, then you realize that the market's going to humble you, right?
Yes.
You make a couple of trades, and even if you start to figure out some little arbitrages, they're very small. Trading back in the days on the Alberta Stock Exchange, before it was the TSX Venture Exchange. It's like, even if you find something, it's like you start to materially move the price if you put any real money in the position.
Okay, Josh, let's stop 1 second.
Yeah.
How many clients have you had that are quote unquote day traders, and how have they performed at their day trading? Because seriously, there's a lot of people out here who play with the stock market, and they day trade and they go here and there, and
yes.
What's the reality here of what you found?
I have seen hundreds of day traders. I have seen dozens who have made real money, like real money, hundreds of thousands or 7 figures in day trading. And I have 0 with any long-term success. Actually, I'll say I've seen one. I've seen one. The hundreds I've seen, I saw one, and he had the humility to get out. He's like, I almost got margined out of my position. It almost failed. And then it, went supernova. And then I got out. And that was the only one that I've ever seen. And, it was like north of $20 million, right?
Yeah. And for me, it's really, you're gambling.
You're gambling.
Yeah. You're trying to time the market when really the smart play is time in the market, not. Yeah.
It was a gamble, right? And so, how do we recreate it? It's like, it's not get rich quick, it's get rich for sure, right? It's a good line, and I say for sure, it's like, but how do I get rich with a really high probability? That's what I'm trying to do, right? Should I use debt? Yeah, you should use debt. Should you use debt irresponsibly? No. Just because you can get the financing doesn't mean you should get the financing.
Yeah, can you service that financing?
That's right.
Yeah.
Can you actually service the financing? Can you service that financing in times of stress?
Yes.
Income debt goes down, rates go up, right? It's like we're living in a high interest rate environment right now, right? And I look at some of my clients and they have debt and they're just like, they might be a little bit scared. And it's like, generally I have more debt than all my clients, but like, we could stick at 7% or it could go higher from there and I could survive for years. It wouldn't matter to me, right? It's been very carefully calibrated on how much debt I'm going to have. And I look at someone else, it's like, they got a T4 job of, $80,000 a year and they're taking a position in 2, 3, 4, 5 short-term rental properties.
Oh my.
They got $2 million of debt on rental properties that only cash flow if the municipal governments don't change the short-term rental rules. Like, whoa, that's, a difficult position to be in, right? But at the same time, if I know someone's not taking on any debt, I know it's becoming increasingly hard to actually beat the real rate of inflation. And so, we're trying to change that odds, and that's kind of what we're going to do here, right? And so that's probably the intro.
Yeah, that's a good intro. Yeah. Well, did you want to look at any comments on the Instagram channel? What's going on in the gram? Because over the past
let's look
few
at
years.
Post. Yeah.
Sure. Okay. So I'm just going to switch over here. Should be that guy right there.
We'll look at our posts here.
All right.
Oh, we got a black screen. Are we on? Are we live on this one?
Should be. Uh-oh.
Oh. Haha.
Uh-oh. Well, it should be that middle screen there. Oh boy. Oh, the fun of technology. So we got Josh.
We got Trevor.
Should be number 6. Something happened. Something came disconnected, of course. Okay. Well, maybe we'll skip that for this time because obviously something happened. We're having technical difficulties.
I think when we come back, that's kind of our goal. Is like we post a lot of these like relevant stats, up on our Instagram channel. It's like, and that's, it kind of shows sometimes like where my headspace is going. I think sometimes people think that I'm on there all day, every day type of thing. Right. But I mean, Ty's on there. So if you think you're talking to Josh, you're probably talking to Ty. It's a little bit of a trick, but usually the post, I've thought about it. It's just probably something I'm thinking of, and then some things that I am, these are things that I monitor anyways, right? Like a lot of times I put information up there because that's what I look at every month. Like I actually look at that every month. Like that's actually important to me, and some people might know why it's important to me. It's like that's what I'll show in this podcast, right? It's like one of the ones we do is a market update all the time. And I put the price appreciation of stocks. And most financial advisors are like, that's not total return. This guy's an idiot. He doesn't know what total return is. Like, guys, I'm a CPA. I went to school for 7 years. I know exactly what total return is, a combination of price and dividends. Like, I get it, right? I've been trading stocks for, a couple of decades. Like, I get it. But why do I look at price appreciation? Is because I can't leverage the prior dividends that I'm paid out.
Right.
Like I can't leverage that. Those are already paid out. It's just the appreciation in the price, and they're taxed, differently. the dividends are taxed differently than the price appreciation. The dividends that you would earn in the US are taxed differently than the dividends that earn in Canada, right?
Right.
And so hopefully with this podcast, like we can like walk people through, you know, what our decision making is and get them down a path on like, what are my first steps, right? What are my first steps and how do I get to that 1.2 million? And if you are at the 1.2 million, it's like, you want to go to 7.3, we'll get you there too.
Yeah.
Right. A little harder path, a little more discipline, becomes a little bit easier with higher income earning power. But, you know, it's my view with anyone with a good at work ethic and reasonable intelligence and patience can get there. And it's harder than it should be, but it's not impossible. And hopefully that's what we can show people in this podcast.
Awesome. Great. Well, thanks for joining us on our inaugural podcast. We appreciate you being here. If you watch this, great. You can leave some comments in the chat or down below. And don't forget to like, subscribe, share it with your friends. And we hope to see you again in what, a week?
A week.
All right. See you then.